Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because while US retail investors are staring at a $1.39 price tag and interpreting that number as a signal that nothing is happening, the largest financial infrastructure project in American history is being constructed in the background, and XRP is listed by name inside the working documents. BlackRock CEO Larry Fink just published his annual letter to $9 trillion in client assets, and the language he used does not leave room for ambiguity. He called SWIFT, the global banking communication system, a 1970s postal service. He declared tokenization the email of finance, and he stated that every stock, every bond, and every asset on Earth will be tokenized. At the same time, the DTCC, the institution that holds over $114 trillion in Wall Street securities, is building a tokenization infrastructure targeting live production by October 2026. Stay with this analysis until the end, because Raoul Pal's macro mathematics produce a number between $121 and $172 per XRP, and that number is not a price prediction. It is the liquidity floor required to route a $100 trillion institutional tokenization shift through XRP's circulating supply. Let us address the psychological environment that US retail investors are currently operating inside, because the $1.39 price is not an accident and it is not a failure. It is a construction. Wall Street uses extended periods of flat, boring price action for a specific and well-documented purpose to exhaust the patience of retail holders until they voluntarily surrender their positions at prices that institutions have determined are the most favorable for large-scale accumulation. The psychological mechanism is precise. Retail investors monitor price movement as a proxy for relevance. When the price stops moving, they conclude that the asset has lost momentum, that the thesis is wrong, that the weight is no longer justified. And the moment they reach that conclusion, the moment they sell, they hand their tokens directly to the institutional buyers who have been waiting at exactly this price level for exactly this supply to become available. The boredom is the strategy. The flat line is the product of institutional design, not market indifference. The historical pattern of institutional accumulation before major repricing events is consistent enough to function as an analytical framework rather than a theory. In every asset class where institutional capital has made a large-scale directional bet, equities, commodities, real estate, fixed income, the accumulation phase is characterized by suppressed volatility, thin retail volume, and a price that appears disconnected from the fundamental developments occurring at the institutional level. The retail investor looking at XRP at $1.39, while Larry Fink is telling $9 trillion in clients that every asset will be tokenized, is experiencing the same perceptual gap that retail investors experienced in every previous institutional accumulation cycle. The price does not reflect the fundamental development, because the institutional buyers who understand the fundamental development require the price to remain suppressed while they complete their accumulation. Once the accumulation is complete, the price is no longer required to stay suppressed. That is when the repricing occurs. The DTCC development is the data point that transforms the XRP institutional thesis from a community narrative into a documented infrastructure reality. The DTCC is not a peripheral financial institution. It is the core securities depository for the United States financial system, the entity that processes, clears, and settles the majority of U.S. equity and fixed income transactions, holding over $114 trillion in assets under custody. When the DTCC builds a tokenization infrastructure, it is not conducting an experiment. It is rebuilding the foundational plumbing of the American financial system. The target date, live production by October 2026, is not a research timeline. It is an operational deployment schedule. And inside the DTCC's industry working group documents for this infrastructure project, Ripple Prime is officially listed alongside BlackRock, JP Morgan, and Citi. That is not community interpretation. That is a documented institutional working group membership that places Ripple's infrastructure at the center of the project that is rebuilding $114 trillion in US securities infrastructure. Larry Fink's letter to BlackRock clients deserves analytical attention that goes beyond the headline, because the specific framing he used signals a strategic commitment rather than an exploratory observation. Fink did not say tokenization is interesting or promising or worth exploring. He said tokenization is the email of finance, a technology whose adoption is not a question of if, but of when, and whose impact will be as structural and irreversible as the transition from physical mail to electronic communication. He identified digital identity verification as the single biggest unsolved problem preventing institutional tokenization from scaling. That identification is significant because it defines the precise technical requirement that must be met before BlackRock can route its client assets through tokenized infrastructure. And XRP has just scored 98.7 out of 100 on the global ISO 20022 compliance test, the highest score of any digital asset achieved natively without wrappers or intermediary layers. Fink defined the problem. XRP's compliance score is the documented answer. The ISO 20022 compliance score of 98.7 out of 100 is not a marketing metric. ISO 20022 is the international standard for financial messaging, the technical language that banks, central banks, and financial institutions use to communicate payment instructions, security settlements, and account information across borders. For a digital asset to route institutional transaction volume through the infrastructure that BlackRock and the DTCC are building, it must be natively compatible with the ISO 20022 messaging standard. Compatibility that requires wrappers, middleware, or translation layers introduces latency, cost, and failure points that institutional risk managers will not accept. XRP's 98.7 score achieved without any wrappers means that XRP can be integrated directly into ISO 20022 compliant institutional infrastructure without the technical friction that eliminates every other digital asset from consideration. This is the technical specification that Larry Fink's problem statement requires. And XRP is the only digital asset that meets it at a production-ready compliance level. Raoul Pal's macro mathematics deserve to be presented with the precision they require because the $172 number is not a price target in the traditional sense, and treating it as one misrepresents the analytical framework that produces it. Pal's projection begins with the documented macro thesis, the global crypto market expanding from its current $2.50 trillion market capitalization to $100 trillion by 2032, driven by institutional adoption, tokenization infrastructure, and the monetization of digital assets by regulated financial entities. If XRP maintains its current approximate 4 to 5% share of the total crypto market capitalization within that $100 trillion framework, the mathematical output is a price floor between $69 and $86 per token based on the 58 billion circulating supply. If institutional adoption through the DTCC working group, BlackRock's tokenization infrastructure, and the Clarity Act regulatory framework pushes XRP's market share to 7 to 10%, a figure that the documented institutional integrations make structurally plausible, the mathematical repricing produces a price between $121 and $172. This is liquidity math. It is the price required for XRP to function as the settlement layer for its projected share of a $100 trillion institutional market. The Evernorth SEC filing adds a supply compression dimension to the institutional math that the market has not yet priced into the current $1.39 level. Evernorth, a Ripple-backed treasury firm holding over 473 million XRP, has filed updated SEC documents, specifically Form S-4, to go public on the NASDAQ through a merger with Armada Acquisition Corp. 2. The significance of this filing extends well beyond a single company's corporate structure decision. When 473 million XRP enters a regulated U.S. corporate treasury structure through a NASDAQ-listed public company, those tokens are governed by SEC reporting requirements, lockup provisions, and fiduciary obligations that make their sale into the open market a complex, disclosed, and regulatory constrained process. They are effectively removed from the retail trading float permanently. And this supply removal is occurring at the precise moment when the DTCC's October 2026 production deadline is creating institutional demand for XRP as a settlement asset. Supply contracting, while institutional demand expands, is the structural definition of a supply shock. The CFTC Clarity Act timeline adds a regulatory urgency dimension that transforms the supply compression narrative into a countdown with a specific and documented endpoint. CFTC Chair Rostin Bainum has stated publicly that he is pushing for the Clarity Act markup by June or July of this year. The Clarity Act, once passed, will establish the regulatory framework that allows U.S. institutional entities, pension funds, sovereign wealth funds, registered investment advisors, and bank trust departments to hold digital commodities in regulated accounts without the legal ambiguity that has prevented full institutional deployment to date. The passage of the Clarity Act is not the beginning of institutional interest in XRP. It is the regulatory event that converts the institutional interest that already exists, documented through DTC's working group memberships, BlackRock infrastructure development, ETF product launches, and direct custody accumulation into unrestricted institutional deployment at scale. The retail investor who sells before June or July is selling before the regulatory gate opens, not after. The convergence of the BlackRock tokenization commitment, the DTCC October 2026 production deadline, the Evernorth NASDAQ filing, the ISO 20022 compliance score, and the Clarity Act June-July markup timeline is not a series of independent developments that happen to be occurring simultaneously. It is a sequenced institutional deployment program reaching multiple visible milestones at the same time because the underlying preparation work that each milestone required was being conducted in parallel over an extended period. The DTCC does not list Ripple Prime in its working group documents without conducting extensive due diligence. BlackRock does not commit $9 trillion in client capital to a tokenization thesis without identifying the settlement infrastructure that thesis requires. Evernorth does not file SEC documents to lock 473 million XRP into a NASDAQ-listed corporate structure without a specific capital markets thesis. These decisions were made months or years before their public documentation. The public documentation is not the beginning of the institutional XRP story. It is the visible surface of a deployment that is already well advanced. The holder psychology question that this dataset ultimately produces is not whether XRP will reprice. The math framework, Raoul Pal's $100 trillion market expansion thesis applied to XRP's documented institutional integrations, makes the repricing a structural consequence of the deployment that is already underway. The question is who holds XRP when the repricing occurs? The retail investor who sells at $1.39 because the price is boring hands their tokens to the institutional buyers who will hold them through the regulatory clarity events, the DTCC production launch, and the Clarity Act passage. The institutional buyers do not need the price to move tomorrow. They have quarterly mandates, multi-year investment theses, and balance sheet structures that allow them to hold through any duration of price oppression required to complete their accumulation. The retail holder who matches that patience, who understands that the $1.39 price is the accumulation price, not the repricing price, is the only retail participant who will be positioned when the institutional deployment completes and the supply that has been removed from the market makes the current price structurally impossible to maintain. The complete picture, assembled from tonight's data, is the clearest institutional signal this market has produced in this cycle. Larry Fink has told $9 trillion in clients that every asset will be tokenized and that digital identity verification is the final unsolved problem. XRP has a 98.7 ISO 20022 compliance score that is the documented answer to Fink's problem. The DTCC is building $114 trillion in tokenization infrastructure with Ripple Prime in the working group, targeting October 2026 production. Evernorth is locking 473 million XRP into a NASDAQ-listed corporate treasury structure. The Clarity Act markup is scheduled for June or July, and Raoul Pal's liquidity mathematics produce a price between $121 and $172 as the structural floor for XRP's documented share of a $100 trillion institutional market. The price is $1.39. The institutions know what it will be. The only variable is whether the retail holders who are currently being exhausted by engineered boredom will still be holding when the CFTC Clarity Act trap snaps shut and the repricing that the math has been calculating for months becomes the price that the market has no choice but to reflect. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.